Oil is sending a dangerous signal right now. Prices are falling, but risk is rising, and that is exactly why this market is so easy to misread. A lot of people look at lower oil prices and assume the pressure is easing. Maybe inflation is cooling. Maybe the market can finally breathe. Maybe risk assets have room to run. But let me put the conclusion right up front. This drop in oil is not necessarily bullish. This is not a recovery. It may be a warning. Because the real issue here is not the price. The market sees price IC behavior. If supply has not improved, inventories are still falling, and oil prices are still coming down, that usually does not mean the problem has been solved. It means something else is starting to break, and that something is demand. Once demand starts getting squeezed, or worse, destroyed, this stops being just an oil story. It becomes a consumer story, a corporate story, a political story, and eventually a market pricing story. That is the part investors need to focus on. Let's start with the core logic. Under normal conditions, commodity prices are driven by three things: supply, demand, and inventories. Tighter supply should push prices higher. Weaker demand should push prices lower. Inventories act as the buffer in between. But what we are seeing right now is not normal. Supply has not really improved. If anything, it has become more fragile. Inventories are not building, they are still being drawn down. And yet, prices are falling. That is the red flag. Because if supply is not improving and inventories are not rebuilding, then the remaining explanation is simple. Demand is weakening. Not because the system has healed, because the system is starting to crack. That is why the JPMORGAN view matters so much. This move lower in oil is not being driven by healthier fundamentals. It is being driven by demand compression and possibly demand destruction. And those are two very different narratives. If prices are falling because the problem is being resolved, that is constructive. The economy can stabilize. Risk appetite can recover. The market can treat that as a soft landing signal. But if prices are falling because demand is being damaged, then lower prices are not the cause. They are the consequence. That is not bullish. That is a lagging alarm. What looks like relief on the surface may actually be damage underneath. And that is where this market gets dangerous. Now, take it one step further and look at what the most sensitive players in the system are doing. Vitol, one of the largest physical oil traders in the world, recently made a very important point. From here, oil price moves are likely to be driven more by headlines than by pure supply-demand fundamentals. That is not just an industry comment. That is a structural warning. In market language, it means something very simple. This market is no longer pricing reality. It is pricing uncertainty. And those are not the same thing. In a fundamentals-driven market, you can model outcomes. You can track inventories, production, demand, shipping flows, and build a view. But once the market turns headline-driven, the next alert, the next geopolitical statement, the next disruption can change the entire price path in a matter of hours. And when a market shifts from fundamentals-driven to headline-driven, one thing moves higher very quickly: volatility. And once volatility rises, behavior changes. That is why Vitol is not leaning harder into risk right now. They are pulling risk in. They are focusing more on physical flows, more on control, and more on managing exposure. Because at that point, the biggest risk is no longer being wrong on direction. The biggest risk is not having enough time to react. That is not normal volatility. That is structural stress. And here is the important part. That stress does not stay on the trading desk. It moves. Next stop, government. France is a useful example here. Instead of trying to suppress the full impact of high energy prices indefinitely through subsidies, the policy response is shifting more toward electrification and alternatives. On the surface, that looks like energy policy. In reality, it is a shift in posture. Governments are starting to accept something much harsher. This is not a short-term shock. This is structural. And if the shock is structural, you cannot keep offsetting it forever with fiscal support. So the role of government changes. It moves from shielding households from the pain to forcing the system to adapt to it. And that shift is not ideological. It is financial. The subsidy wave in 2022 already put real pressure on fiscal capacity across Europe. Debt is higher. Rates are higher. And the cost of extending support keeps going up. So now the question is no longer whether governments want to cushion the blow. The real question is whether they can still afford to. And once the market realizes governments are moving from short-term stabilization to long-term structural adjustment, the pricing framework changes to, now let's move to the consumer. Because this is where the story becomes much more real. A lot of people are still looking at traditional macro data jobs, retail sales, headline consumption, and saying the consumer still looks okay. But markets do not wait for lagging confirmation. They react to behavior first. One of the most important signals in this story is this: Barclays. Card data showed that U.S. consumers bought about 8% less gasoline over the last 30 days than they did a year ago. Even with prices higher, that matters, because it tells you consumers are not just spending less, they are reallocating, they are driving less, they are controlling purchase size, they are adjusting behavior under pressure. That is not demand disappearing overnight. That is demand getting squeezed. And once people start making those adjustments, the effects do not just vanish because prices pull back for a few weeks. That behavior can stick. People drive less. They spend less. They delay purchases. They cut the non-essential spending first. And that is why sustained pressure in energy does not just hit the gas bill, it reshapes the consumer spending mix. Money starts moving out of discretionary purchases and into essentials. From wants to needs, from brands to bills, from upgrades to survival. And once that happens, the story stops being about energy alone. It starts showing up across consumer sectors. That is why weakness in apparel matters. A lot of people look at that and treat it like an industry-specific problem. Inventory, channels, brand mistakes. But in this context, it looks like something bigger. It looks like discretionary demand is starting to crack first, and that makes sense. Consumers do not stop eating first. They do not stop paying rent first. They stop buying the next pair of shoes. They stop buying the jacket they can delay. They stop spending on things that are nice to have, but not urgent. So what is actually happening is not an instant collapse in total consumption. It is a shift in composition. And once spending composition changes, the pressure moves up the chain from end demand to orders, to inventory planning, to suppliers, to margins. That is why pressure on companies like Nike is often not just about the company. It is about a consumer system that is becoming more fragile. And one of the most important signals here is falling order visibility. That is a very professional term. But the meaning is simple. Companies can no longer see clearly into the next 3 to 6 months. And when companies lose visibility, they do not get aggressive. They get defensive. They do not expand capacity. They do not preload inventory. They do not place bold orders. They wait. And when one company does that, it is normal. When an entire sector does it, growth gets marked down. That is why real economic turning points do not show up in GDP first. They show up in behavior first. In one less trip to the gas station. In one smaller order from a buyer. In one less risk position from a trader. Each move on its own can be explained away. But when all of them happen at the same time, the message becomes very hard to ignore. The system is turning defensive. And if you think that is where the story ends, it does not, because the pressure keeps moving. Now it reaches politics. Tax cuts are supposed to support consumption. That is the theory. But if any benefit households get is immediately eaten up by higher energy costs, higher food prices, and higher rent, then the political result is obvious. On paper, people may have a little more money. In real life, they feel poorer. And that gap matters because macro data can be revised. Economic narratives can be explained away. But voter sentiment cannot. Once the pain starts affecting approval, elections, and policy room, this is no longer just an inflation story. It becomes a system story. And now we get to the heaviest part of the argument. The coldest conclusion here is also the most important one. Oil is not falling because supply is rising. It is not falling because inventories are being replenished. It is falling because demand is being damaged. That changes everything. Compress the logic and it becomes very clear. Supply has not improved. Key exports are still under pressure. Inventories are still being drawn down. Global inventories are already down by roughly 265 million barrels. Under normal conditions, that should support higher prices. But prices are falling anyway, which means one thing. Demand cannot carry the load. And one of the hardest pieces of evidence is what happened to European refining margins, falling from positive territory to around negative $15. What does that tell you? It tells you the middle of the chain is starting to lose money. It tells you the system is struggling to pass through upstream costs. It tells you end demand cannot absorb the price. That is not just a pricing issue. That is a capacity to pay issue. And when the refining layer starts feeling that pressure, you know the stress has moved beyond the consumer. It is now spreading through the middle of the chain. Then there is the inventory floor. Inventories are moving closer to operational minimums, with a key point around mid-May that matters because inventories are the cushion. As long as that cushion is there, the market can absorb shocks. Once it gets too thin, the system has fewer options. Then the market is forced into a harder adjustment. Either prices move sharply higher again to ration demand, or demand gets hit even harder through economic weakness. Neither path is comfortable. So the real question is not whether oil can fall a little further from here. The real question is whether this demand destruction process keeps spreading. And finally, zoom out to the global macro picture, and Japan becomes one of the clearest warning cases. Because Japan is facing one of the most dangerous combinations in macro: higher inflation and weaker growth, tighten policy, and you pressure an already soft economy. Stay too loose, and inflation pressure builds. That is not a fine-tuning problem. That is a structural dilemma. And Japan is especially exposed because of its heavy reliance on imported energy. For the US, oil is often discussed as an inflation variable. For Japan, it is closer to a direct input cost. If energy stays volatile and elevated, Japan's cost structure gets repriced. And if Japan is eventually forced into a tighter stance, the consequences may not stay local. Carry trades can reverse. Global capital flows can shift. Liquidity conditions can tighten. At that point, this is no longer just about oil. It becomes part of the global asset pricing story. So when you step back, the full chain becomes clear. This is not an isolated commodity move. This is a risk transmission chain that is already in motion, from traders, to governments, to companies, to consumers, to voters, to central banks. And the most dangerous part is this. Once that kind of chain starts moving, it rarely stops cleanly in the middle, because each layer reinforces the next. Corporate caution hits hiring. Hiring pressure hits consumption. Weaker consumption hits profits. Weaker profits hit investment and expansion. This is not a one-way shock. It is a feedback loop. So the real issue now is not whether oil has come off the highs. The real issue is whether this broader adjustment has any reason to stop. Because when people drive a little less, spend a little less, and delay a few more purchases, they are not just making spending decisions. They are changing how they live. And once enough people do that at the same time, personal adjustment becomes economic direction. So do not let the falling price fool you. It may look like risk is fading, but underneath, the opposite may be happening. Demand is being compressed. Behavior is changing. The system is getting more fragile. And the market is moving from pricing expectations to absorbing reality. Historically, the most dangerous phase is not always the most dramatic one. Sometimes the real danger begins when things appear to be calming down, because that is when the panic fades, but the structure starts to loosen. So I do not want to end this with an easy conclusion. And I definitely do not want to turn it into a buy or sell call. I just want to leave you with one idea. What looks finished may only be getting started. When prices change, markets price expectations. When behavior changes, markets absorb reality. And when policy is forced to adjust, the next phase has already begun. The only question is, which phase are we in right now? If you want, I can take this one step further and turn it into a fully performance-ready anchor read. With pause marks, emphasis cues, and camera beat formatting for recording,